Hello, good morning to everyone. Um, you're welcome to the first in a number of uh, webinars that Petra Trust intends to hold to address certain concerns that we are currently facing within our economy. The first of which is today's webinar, which we're looking to understand the current economic situation and what Petra's interventions are with regards to scheme members. And so I want to extend a warm welcome to everyone that is joining us this morning. To our scheme members as well, you're welcome. We have on the panel today very seasoned speakers who will be addressing the questions that we have, providing some insight into what is happening in our economy today, and we'll be giving some advice as to how we can navigate these turbulent times. Just before I do the introductions, a few housekeeping rules. For those of us who have joined the webinar, if you have any questions, we encourage you to send it in the Q&A section, and we will attend to it in due course. So please feel free to put in your questions there. Any question you have that is related to what we are discussing, kindly indicate it in the Q&A, and then we will address it in due course. We also have this webinar on our social media platforms, primarily Facebook and YouTube. For those of us who want to view over there as well, you can do so, or you want to share the link with somebody so they can join in as well. That'll be fine. So we'll get right into our discussion for today. As I mentioned earlier, we have some seasoned industry players with us this morning to help us address the topic for today, which is understanding the current economic situation and Petra's interventions. So I'll start off by introducing our panelists. We have today joining us Mr. Courage Mate. He's an economist and the head of insights at IC Group. He's been working in the industry for the past 10 years, and he has experience in economics, credit risk, and capital markets analysis. Before joining IC Group, he was the senior economist at Data Bank Group for 8 years. And we hope that he will bring to this conversation that wealth of experience to help us understand what's going on. So, Courage, a good morning and welcome once again. Also joining us is Rita Yeboah. Rita Yeboah is the current Vice President of Institutions and Pensions at Blackstar Group. She's been working in the finance industry for about 6 years now, and she also has expertise in managing portfolios that are curated to pension industry standards. Welcome, Rita. We have also joining us Yvonne Buliga. She is the head of portfolio management at Petra Trust. She has over 80 years of experience working in the financial sector and is responsible for the management of over 10 billion in assets. She also brings a wealth of experience and knowledge in the management of funds to this conversation. And last but not least, we have Mr. Eugene Birkran. He is the current general manager for Petra Trust. So though he's not a panelist, he'll be joining us to help us address some of the questions that you may have that are on your minds. But before we progress, we'd like to hear the voices of our panelists. So good morning to you, ladies and gentlemen.
Good morning, Solomon, and good morning to scheme members on the call today. We hope that we'll be able to put our thoughts together and share some insightful comments and commentaries and views that could assist us in decision making going forward. Thank you.
Thank you. So we'll quickly take a forward from the general manager for Petra Trust before we get into the discussions proper. And so, Mr. Birkran, please, if you may kindly give us a word before we begin.
Yes, good morning. Thank you, Solomon, and thank you everyone for joining this webinar series. This is the series of many that we will be doing to equip people and members with the knowledge and the skills that we need to make informed decisions. I'm particularly excited, even though we are dealing with very trying times. This is because in my line of work, I have dealt with quite a number of people that have had to suffer a lot of losses because they are uninformed in their decision. I understand that when it comes to investment and finances, most of us would rather leave it to when problems arise like what we are having now. But I'm hoping that the silver lining of this cloud is that we begin to become more active to understand our finances, our investment decisions, and the forces that are at play so that we don't leave our future to chance. So I trust the panelists that are on. We welcome and thank you so much, Rita, Courage, Yvonne, and the team, and everybody else who has joined this webinar. And I'm looking forward to a lot of insight, a lot of understanding of what is going on and what we should be doing, how we should be viewing our investment and our future. The forward that I'll give to us is that markets fall and markets rise, but over the time, you need to know what to do when markets fall, and you need to know what to do when markets rise. It is a wave particle, something, and it happens throughout life. To become a very good financial person, you need to be informed and you need to have the relevant information and the skills to be able to decide what to do. Petra, we've put ourselves forward as your experts and as your advisors throughout the changing season of investments fora. So you're welcome. I trust that we'll have a great time and we'll be able to begin to demystify a lot of what is happening and create a path out of the storm for everyone. Thank you very much, Solomon, and I wish you all the best throughout the session.
Okay, thank you very much, Eugene. As Eugene mentioned, my name is Solomon, and I'll be moderating today's discussion. Again, reminders to everyone on the webinar. If you have questions, kindly indicate it in the Q&A section. If you look at the top of your screen, the top right corner, just beside where the chat icon is, you'll see a Q&A icon over there. So you can kindly click there and then input your questions. We'll be taking them as we go along during the webinar. All right, so we want to go straight into our discussions for today. And my first question is directed to you, Mr. Marty Courage. Where have we come from, and where are we now in terms of our current economic situation?
Well, thank you very much, Solomon. I would say we have come from a place where none of us ever imagined that we can be in this place today. Because if you look at where we are today, we are seeing inflation, that is prices of goods and services, rising at a very fast pace, a pace not seen since 20 years ago. We are seeing the currency depreciating at a pace not seen in over 20 years. We are seeing interest rates at a very high level, a level not seen in also 20 years. So we have come from a place where most of market participants and economic actors have become so comfortable with the new normal of relative stability, good returns, and never seen this level of losses on the market before. And so going forward, one thing I would like us to have at the back of our mind is that this is not a situation that is normal, because like I said, we've not seen this in 20 years or so. And so we should also expect a turnaround from this point. So essentially, we are in a difficult situation. We are in trying times. And how did we get here? I guess that would be the question you would want to ask. So I would say we got to this point with a combination of external factors and domestic policy choices that probably backfired, because if you go back a bit to 2018, when we're just exiting the IMF program, a program that helped us sustain, or should I say maintain, a discipline in public finances, where the gap between government revenue and government expenditure was brought to a certain small level, so that gap, if you are to finance it by borrowing, you borrow at a rate that you'll be able to pay. But from that point, since 2019, what we notice is that the gap between government revenue and expenditure started widening. And it means that the rate at which we were borrowing started going up faster and catching up with our ability to pay. When we got to 2020, then the pandemic struck, the COVID pandemic struck, and that reduced government revenue, increased government expenditure, and spiked or increased even further the rate of borrowing that we needed to do. And we did that consistently for 2020, 2021, and now in 2022. So essentially, our rate of borrowing and the rate of increase in our debt has overtaken or has increased beyond our capacity to pay this debt. And this has also led to a faster increase in inflation because the government had to rely a lot on the central bank to support it with cash or liquidity to support that excess spending. And that increase in money supply consistently for 3 years also led to the situation where what we call more money chasing few goods on the market. And that is what we call inflation, causing prices of goods to rise at this very fast pace. Now, when prices of goods rise at this pace, the central bank has to respond. The way they respond also is to increase interest rates and signal to other interest rates on the markets to follow suit. And that is why we also have interest rates on bond securities at high levels not seen in over 20 years. Now, there is a negative or inverse relationship between interest rates and the prices of bonds or the value of bonds. So with interest rates at these very high levels, it is only to be expected that on the reverse side, prices of bonds or the value of bond investment will fall significantly. And that has brought us to where we are today in a nutshell.
That's interesting to note. So you mentioned in your submission that we've come from a place of stability, more or less, and we are now experiencing some kind of distress within the economy. Is this something that is peculiar to Ghana alone, or it is the world over?
Well, it is the world over, but the extent of issues you face in any economy depends on the state you are in at the time the issue began. You understand? So if you were already struggling to keep a very good public financial condition or macro stability, then when a little shock hits, some people can be able to weather the shock better than others. And those who are able to weather the shock better than others are those who have a relatively better macroeconomic condition where inflation is traditionally in low single digits. In other words, prices of goods and services do not always rise very fast. Now, also in a situation where the stock of foreign currency they have at their central bank is enough to be able to support the local currency on the market even before the shock happens. And also those economies whose governments are not borrowing at an already fast pace and now having to increase even the pace of borrowing to overtake their ability to pay those debts. So it is all over the world, but the rate at which it hits economies and how economies go under depends on where they were at the time the shocks happen.
I see. And so you mentioned earlier that there were some external factors to this and there were some internal factors. So essentially what you just said is that we were not prepared, or our economy was not prepared for the kinds of shocks that came, and that has caused us to be where we are today. As part of the external factors, to bring some clarity to our audience, the external factors you mentioned, you did mention COVID-19 pandemic. Apart from the COVID-19 pandemic, were there any other factors that contributed to this?
Yes, so COVID-19 pandemic came with a sharp decline in global oil prices. And you know, our public finances depend on oil revenue. And that oil revenue to the budget didn't come through. That was through 2020 and then into 2021. In the latter part of 2021, oil prices started recovering. But when they recover, they need to recover at a certain pace that the balance of payment, in other words, the amount of dollars you need to import, because we also import oil, right? So when they recover, you need it to recover at a pace that the stock of reserves you have, foreign currency you have, will be able to support the importation of oil. But in early 2022, Russia invaded Ukraine, and Russia's invasion of Ukraine triggered other things: sanctions on Russia, sanctions on international transactions with Russia and Russian banks, and so on. And so that caused an increase in the price of oil on the market. And so today we have to deal with higher prices of oil on our market, which is driving the inflation levels we see today. Secondly, we also have the disruption to the international flow of trade, partly because of Russia's Ukraine war and partly because of COVID. I mean, COVID started it, but then Russia's invasion of Ukraine worsened it, so that movement of food items like wheat, millet, and other cereal from that region to the rest of the world was also curtailed or displaced. And because of that, food prices also went up and also impacted the rate of increase in general price levels. So Russia's invasion of Ukraine is one major external factor that we have experienced this year. Before, we also saw international rating agencies downgrading various economies, and particularly the case of Ghana, which is currently near technical default zone, which means that investors would not want to lend us money as a country. And because we have always relied on foreign capital from foreign investors or non-resident investors, that also has not come true. That meant that the central bank didn't have the regular source of flow they get into the reserve to support the local currency, hence the depreciation of the local currency or the continued loss in the value of the local currency. So in summary, in addition to the COVID pandemic, we've also had Russia's invasion of Ukraine also causing significant shock to major economies, and Ghana not being able to cope with it well because of our earlier problems.
So would you say, Kariji, that the challenges that the government faced with executing or getting approval for the budget earlier on affected the way we're running the economy, and because of that, we are seeing much distress in the economy as of today? So policies around the e-levy and things to raise what do we call it, revenue to support the government expenditure. These delays that we're experiencing in the passing of the budget and all of these, did this also contribute to what we are currently experiencing in Ghana?
Well, I would not be fair to say it didn't contribute, right? Because the uncertainty also didn't help. But see, in totality, we also need to take a step back and also look at the sentiments around the budget even before it was presented, before we even got to the stage of waiting for an approval. So non-resident investors had already started flagging concerns around government finances and concerns around our public debt, whether we'll be able to pay. And so if we look back, the cedi's depreciation and the outflow of foreign investors from our market began as far back as October 2021. That's the point where the 2022 budget had not been presented. And the government response was that they were going to present a 2022 budget that would cure the concerns around public finances. When the 2022 budget was presented, a scan on the market revealed that a lot of investors did not believe that the budget had the credibility to correct the concerns they had with public finances, largely because the expected revenue that the 2022 budget was supposed to rake in was too ambitious. And because of that, they didn't see how we could achieve that revenue target in the first place, even before there was back and forth around approval or not to approve it. So I believe the delay in approving it contributed, but if you were to assign weights, the market already didn't trust the 2022 budget even before we suffered the delay with approvals.
Yeah, that's interesting, and I'm glad you brought in that bit of clarity. It helps with the discussion. Let me move on now to Rita. With all of this going on within the economy, how has this all affected the financial markets where we all play in putting our monies to invest to get a return. How has this affected these markets?
Sure. Thank you, Solomon, for the question. And like Courage alluded to, investor confidence was lost. He mentioned our public debt profile was going up. There were concerns as to whether or not we will be able to generate enough, money to pay off these debts in terms of even maturities and coupon payments. And so that uncertainty means that it sort of reflected in the pricing of securities that we had on the market. And so if you looked at the government bond issuances that were on the market, the interest rates on them went up. That means that the prices went down, and essentially that meant that the value of those bonds had gone down. When we received the credit rating downgrades, it essentially meant that investors did not believe that we'll be able to pay those debts, and so that's why our risk had gone up. And so if you wanted anybody to take on those securities, essentially you would have to be willing to sell at a very low price. And so that's what happened in terms of the financial market that we play in. It reflected in the prices, not just even on the bond market, but even on the equity market as well. And so if you look at the Ghana Stock Exchange Composite Index, it's down over 10% from beginning of the year. It's the same. It has been the same on the bond market as well. And just to add on to it, that also another thing that also didn't help was with all the speculation that was going on. I think communication also didn't come, as and when it was needed, and so that also worsened the situation. And then, apart from communication not coming from the right sources, you also had a lot of people bringing in their own perception, their own views, and that also again further worsened the situation on our capital market, both in terms of fixed income and then equity.
I see. So in essence, there was a lot of uncertainty on the market, and that's affected the way the market players rated prices on the market up for investments and the like. That's interesting. Yvonne, can you give us some insight as to I think that Courage alluded to it earlier, but can you give us some insight as to the relation between interest rates and bond prices, and how those two, how do we call it, interplay, and how it's affecting the market today?
Good morning, Solomon. Good morning, my fellow panelists. Good morning, team members. Thank you very much for having me, and thank you for the question, Solomon. So I'm going to use an example to make it more practical. So if we have a phone, right? Let's assume the iPhone. We are holding an iPhone 10, and it has a value of, let's say, 100. Right. And it comes out that they are coming to issue a new iPhone that comes with better features and the likes. You'd notice that people would not be looking to buy the iPhone 10 anymore, but they'll be now looking to buy this new iPhone that's going to be released. What that means is that the value of which you were holding the iPhone out of 100 will now end up not being attractive because people are expecting, there's no demand, or people are not interested in the item that you have in the first place. So what typically will happen is that if you want to dispose of this iPhone, what you will do is to basically try to make the price attractive so people can actually purchase this iPhone from you. So your iPhone that was worth 100, you try to make it have a price of about, let's say, 70 or 60. So you can be able to get people to be interested to purchase the iPhone from you. So I'm going to link this to the financial market. So this iPhone example is just supposed to give an example of how demand and supply works. When there isn't a lot of people interested in a product, you need to be able to make the price attractive for them so that even if it wasn't on their radar, we can be able to, you can be able to get them to start to consider it just because the price is cheap or affordable. So when you link it to our financial markets like this, what you see is that anytime the government comes out with a certain bond that is at a higher rate, or anytime that rates increase on the market, right? What it means is that the older bonds that are in existence that have lower rates are not as attractive. So you'd notice that for those bonds, the supply or the demand, let me use demand, people won't be demanding for those bonds as much as the newer bonds that have better rates. So what happens is that for those older bonds, their prices will have to fall so that those who are not interested might start to look at those bonds. So you notice that anytime the interest rate starts to rise, prices of already existing bonds start to fall because there'll be better options with the increase in interest rates. And you have to make the older bonds become more attractive to people so they can also purchase those older bonds. So that's basically the relationship. It's an inverse relationship, but that's the science behind it. Thank you.
Thank you, Yvonne. So this question is actually an interesting segue into the next, which is a term that we've been hearing often now, mark to market. How does this relate to mark to market terminology that we have been hearing so far? If you can throw a little bit more color on that as well.
All right. Thanks once again for the question. So with the same analogy, this year we saw that interest rates started to rise, like what my other panelists have mentioned. There have been concerns on the government's ability to repay its borrowings, right? Anytime someone says, I'm going to buy a treasury bill, I'm going to buy a government bond, we are basically lending money to the government because the government issues these treasury bills and government bonds to raise money for their various projects or expenses. So this year, with people having concerns on this, you notice that the government couldn't really focus on our external investors, like Courage mentioned earlier. They have to focus more on the domestic investors, that the Ghanaian investors like you, scheme members, myself, pension funds, banks, collective investment schemes, other institutions, etc. And what that meant was that for we, the Ghanaian investors, besides having concerns on the government's ability to repay its borrowings, we are seeing inflation numbers to rise. So we want to be compensated that, if inflation price levels of goods and services in the country keeps increasing every month, I'm seeing it go way beyond the medium targets band that has been set. I need to be compensated for whatever money I'm letting go of, so my money doesn't lose value. So this burdened the government even more. And what that meant was that now each time that they kept coming to borrow, they had to borrow at rates that were high that these various investors will be interested in. I'm sure people will be wondering, why is government borrowing, right? And it's because, similar to what has been mentioned, the government has been spending way more than it's been making. And the unfortunate thing is that some of the expenses of the government, they are rigid. They can't do much about it. Some of which being even the borrowings. The government, it's like you go and you borrow money from the bank. You really can't do much. You have to pay. If you owe the bank money, you need to pay. Same thing with the government. You owe people money, you have to pay. So for some of these expenses, the government doesn't really have control over it. And this is the case where the revenue or the sales that they are making is not even sufficient to be able to pay for these expenses that they are supposed to honor. So they have no other option but to borrow. And they kept borrowing from us. And we too demanding for higher rates. Inflation is high, currency is depreciating. Like basically the money we had at the start of the year, if you look at how much it was in dollars and look at it now, you realize that it's really close to peanuts because it's not the same. All of these things may basically that compensation. So with the government still coming back to the markets to borrow and still having to meet the needs of us, that is making sure that they give us the rates or the interest rates that are attractive. Like the example I shared earlier, it means that all of the older bonds that are issued before each time that the government came to the market, their prices would have to fall because they'll be no more attractive. I mean, if you were holding a security that had an interest rate of about 15%, and now the government is issuing a bond or a treasury that's going for about 28 or 29%, you will not be interested in buying that security that had an interest rate of 15% a few days or weeks back. You'll be more interested in the new issuances. So now these older bonds, their prices had to fall so that people could be compensated. So instead of buying it as, let's say, 1 CDS to 1 note, they're telling that, okay, you buy it at 70 pesos to 1 note, or buy it as 50 pesos to 1 note, so that we can compensate you for the overall cash flow that you receive from this bond or treasury bill that you are purchasing. And as a result of that, we saw across board prices fell for all of these bonds. And unfortunately, for some fund management access companies, they are required by a directive from their regulator, that's the Securities and Exchange Commission, to mark their portfolios to market. What that means for them is that now these low prices of the bonds, so same thing, you had your bond or your treasury bill, had a price of 100. Now the prices on the market are falling. So your price is now at 40. What it means is that if you were holding a bond that had a value of 100, now the value of that bond that you were holding in the mutual fund or the unit trust is 40. And that is how come we are seeing what is happening now with the collective investment schemes and people seeing balances different from what they actually saw earlier in their statements. But that's the whole concept of the mark to market. It's just ensuring that the securities that you hold show a true reflection of what the market value is using market prices. Thank you.
Thank you, Yvonne. Eugene, you'd like to add to that?
Yes. Thank you so much. So, I mean, I just want to maybe this investment terminologies and understanding is a wide variety of people we're talking to. I like to pick up from the base. So basically, if you bought a treasury bill from the government today, and it's supposed to be for 6 months, and it returns 30% or 20% or whatever it returns. Your intention is to hold it, and then when it gets to the 6 months, you go back for your actual money. So if you pay the 100 CDs for the treasury bill, they pay you interest, and at the end of the period, you go for your money. Now, that is holding to maturity, or what we call amortization, right? Now, when you before the 6 month ends, you get a problem, for which reason you want to dispose of that treasury bills that you bought. You can't go back to government and say, hey, I bought a 6 month treasury bill from you, but I need money now, so take it and give me my 100 CDs. You have to sell it on what we call the secondary market. Somebody else who is willing to take over that treasury that you purchased. And that is where the secondary market comes in. And that secondary market will price it or decide that, oh, I want to pay you this amount. This is how much I have to pay you. You want to sell it, it's 100 CDs. That's how much you paid for it from government. But now I will give you 80 CDs, or I'll give you 120 CDs, or I'll give you 30 CDs based on the market conditions. And you decide to accept or not to accept this. So there's this valuation methodology based on the way funds are structured, that we want to see what you actually hold. If we buy to hold until the maturity time, we get the full value of what it is worth. But if we buy and we want to trade it before the maturity time, we market to the market, as in what the market is willing to pay for it today. And as the panelists have shared with us to this minute, as you can know, the markets are not doing well. Ghana's macroeconomics and the stability don't look good. And so investors are not willing to pay good value for the securities that are available, especially the ones that are issued by government. And so when your fund manager is reflecting what the market is willing to pay for the securities that they hold, that is marked to market. It means that if I had to sell your securities now and give you your money, this is what you will get. When in other funds like pension funds, which are longer term funds, are not forced to sell a lot of times until certain situations occur, are holding to maturity. They hold the value as though we are waiting for the securities to mature, and then we get the full value for you. However, we are still open to trade when the value looks better on the secondary market, all in the aim of making sure that we get a better return for you. So in certain market conditions, the price of your bond can increase. I mean, when, like they said, the same inverse relation, government is doing better, stability is very good, and government says, listen, I'm going to issue bonds that are lower price, or other factors to make sure that the returns on the bonds are lower. It means that people will be willing to buy older bonds at a higher price. And fund managers decide on what to do at that time to ensure that they maximize the returns. I hope that this helps to put in perspective mark to market and hold to maturity in prices. Most of the collective investment scheme, which are the mutual funds that people invest in, SEC has issued a directive to mark to market, as in reflect the actual value of your securities on the market as if they were selling it today. And that's why people see some of these drop in value. Pension funds are not on the same trajectory. We hold to maturity, especially with government securities. And so those are the different things. And I think over the past couple of weeks and months, this term has been running around. And I hope this helps to bring some clarity to it. Thank you.
Thank you, Eugene, for that. So we've been talking about how the state of the economy has been so far. But for me, and I'm sure for a lot of listeners on the call, we would like to know, is there an end in sight? What are the things that the government is doing sort of to mitigate the effects of the current economic crisis we are facing? And Courage, I'll direct this to you. We've heard about debt restructuring and whatnot. What does that mean? And what are the things the government is doing? What are the things the government is doing to sort of mitigate the effects of this economic crisis we are in?
Sure. Thanks. So before we discuss what the government is trying to do to mitigate or correct the challenges we are faced with, let's just have a quick touch on what we mean by debt restructuring. Now, what is a debt? Basically, debt is a loan between, let's say, at least two people, right? Two parties. Now, when the loan is agreed, there is a certain contract that determines how much the loan is, how it will be paid back, and what it will cost the borrower in terms of the interest that the borrower will be paying periodically. And so there are various terms or clauses or conditions that are put together and signed by both parties, agreed by both parties. And the loan agreement takes off. And as and when it is due, the interest on the loan is paid. It gets to a point where the borrower may suffer some issues, financial issues and whatnot, and may not be able to continue with that term or agreement. And so there may be the request for us to change the terms of the loans or the agreements. Now, any action that changes the terms of the loan agreement is a restructuring of the loan. So there was a structure for the loan, amounts, interest, and maturity, or when you will pay back. That was the structure. Now you want to restructure, change the structure, change the agreement. That is what we mean by restructure. So it's just a fanciful name for actions taken to change the content of an agreement of the loan. Now, that is part of what government is currently doing to correct the situation, to change the agreement between the government on the one hand, who is the borrower or an issuer of a debt or a loan or a bond or treasury bill, and the investor, you and I and institutional investors on the other hand, who are the creditors or the lenders. We had an agreement with the government. I give you a certain amount of money, you pay a certain rate of interest on it over a certain period. The government finds itself in a certain situation and cannot continue to meet that, and they have come to say, let's restructure. And there are various ways to do the restructuring. But essentially, that restructuring is one of the things the government is trying to do. And how this will correct the issue is that, so the loan, for instance, the pressure on the government to pay loans with monies it seemingly does not have is what is leading to the kind of inflation we're seeing today, the losses in the value of the currency we are seeing today, because the government is under pressure to pay. It doesn't have the money, enough is not coming in by way of tax revenue. So what it is doing is to fall on the Bank of Ghana to give it more supply of money to be able to pay the loans that are due for repayment. Now that is increasing the supply of money in the economy beyond the output or goods and services that are being produced in the economy. And that creates more pressure on the low supply of goods and services and causes prices to go up. And so government's continued pressure to pay these loans, falling on the central bank, increasing the supply of money because it has to pay, is one of the reasons why prices of goods and services are going up. And so to beg, loosely, for restructuring or changes in the term of the contract would help government not fall on the central bank again immediately to pay this debt. And then the amount of money that is injected into the economy can slow down. And then the price increases can reduce, and we start to see some stability in the economy. And we can use the same thing for the foreign currency debt that the government has, where the stock of foreign currency at the central bank is always being used to pay the foreign currency debts. But now, if they speak with the foreign creditors and they allow some breather in terms of restructuring or changing the terms of the loan agreement, government will not have to continue to put pressure on the stock of limited foreign currency we have. And that will help the central bank accumulate or build foreign currency to support the currency and also maintain currency stability. A stable currency also means a stable or lower inflation. And then the economy should start to stabilize. Now, that is one leg. And this leg has to be firm before we can move on to the next leg, which is an IMF program. The International Monetary Fund, or an IMF, is an institution that was set up by a group of countries who pools resources together to assist member countries that find themselves in this kind of trouble that we find ourselves in. So they bring their technical expertise, cross-country knowledge to assist a country because they have experience from other countries that they've helped. They also have a stock of foreign currency that they can use to support your reserves. And all of these, with the technical support they will give you, will help you find ways of raising more money and also ways of better spending the money, so that you will not have to go on the market to always borrow and create the debt problem you have right now. So the IMF program becomes the second leg or second solution that the government is also working around. But without concluding on the debt restructuring, we will not be able to start the IMF program. And that is where we find ourselves in. And that's why the government is working around the clock to get the debt restructured.
Interesting. We just heard, I think 2 days ago, an announcement by the Minister of Finance, Ken Oforiatta, about debt exchange. Is this also part of the debt restructuring, and what does that mean for us as investors or scheme members?
Yeah, sure. The debt exchange is a part of debt restructuring, because by the very nature or way in which the debt exchange would be implemented or carried out amongst the parties involved, it will lead to a change in the original term of the debt agreement or loan agreement, because the existing bonds today have certain interest rates on them and they have certain amounts that were invested. Now, the debt exchange is saying that surrender those bonds and let me give you a new type of bond. So let's kill off those bonds. Let's kill off that agreement. Let's have a new set of agreements, which one will preserve the face value, the original value or amount you put into that bond, but would reduce the interest I have to pay compared to the original one. So you will see that there's a change in the agreement now. So that is restructuring. So the exchange means that I'm taking that bond from you and giving you a new bond. So we are exchanging one bond for the other. But it is a restructuring because it will lead to a change in the original terms. In this case, the principal or the original amount is not changing, but the interest that the government will be paying on it will be lower now. And that change means that it is a restructuring, even though it is a type of restructuring called debt exchange.
Okay. Thank you, Courage, for that. Yvonne, can you throw a little bit more a color on the debt exchange? What really goes into it, as the minister announced it? And I understand also that the Chamber of Corporate Trustees has issued a communique with regards to this debt exchange. If you can just give us some information as to how corporate trustees are responding to this and how it affects scheme members as well.
All right. Thank you very much, Solomon, for the question. So your question was in two folds. The first one is what the whole exchange is, and then the second one is the stance that the corporate trustees have taken. So I'll take the first one, and then after that, I'll take the second one. So for the whole exchange program, first of all, I'd want to reiterate that it's an offer. So it's not something that whatever that was announced doesn't mean that's what's going to happen. It's going to be a collaborative effort if it should happen. However, it's just an offer, and people have the opportunity to either accept it or not. So with the exchange program, what the government is saying is that for all of the existing bonds that we have, treasury bills are exempted. But for all the existing bonds we have that have been issued by the government and also issued by their state-owned enterprises, i.e. ESLA and DACHE, for these bonds, they want to exchange it for a set of 4 new bonds that Courage added. However, they are going to exchange it in a particular way. So for all of these bonds, whatever value you have, 17% of it is going to be put into a 5-year bond that will mature in 2027. The next, another 17% will be put into a 7-year that will mature in 2029. 25% will be put into a 10-year bond that will mature in 2033. And then the remaining 41% will be put into a 15-year bond that will mature in 2037. In addition to that, what they are offering or they are asking people to consider is that one, in 23, there will be no interest, there will be 0%. In 2024, there will be a 5% interest. And then from 2025 to the end of the lifetime of these various bonds, it will be at 10%. In addition to that, they also mentioned that for the 5-year bond, given that you're just putting 17%, same as the 7-year, but you're also putting in just 17% of the overall face value of the bonds that you hold, they would pay you back your principal in 2 equal installments in the last but 1 year and the last year of these bonds. For the 10-year bond where you're putting 25%, they'll want to compensate because you're putting 25% in there. So they'll pay your face value to you in 3 equal installments in the last batch 2, last batch 1, and last year. And then for the 15-year where you have the bigger chunk of your face value going, they'll pay your principal to you in 5 equal installments from the last 5 years onwards to the last year of that particular bond. So that is what the whole debt exchange program entails. The next question, sorry, I think I might have forgotten, was it what it has to, the position that the trustees have taken, right? When you look
Yes,
at
before
exchange,
you go to, sorry, Yvonne, before you go to the position the trustees have taken, if you can elaborate a little further on how it affects scheme members, this debt exchange,
okay.
how is it going to affect scheme members? Yeah.
Okay. So once again, it's just an offer. So it's not going to be implemented until it becomes the reality. That is if it becomes the reality. But should that be the case, what it means for scheme members, that is Petra scheme members, is that we have most of our schemes actually holding these securities. We have over 50% of the schemes holding these securities. And it's just by design. You know, the way the regulations have been designed is requiring that most of the schemes hold a huge chunk in these sort of securities. So definitely what it will mean is that for next year, 23, where there's going to be 0 coupon, for that portion of the scheme, that if this becomes the reality, would be affected, would be earning 0 returns. And the list continues, like I mentioned earlier. However, what the Petra team, my team in-house, is working on together with the fund managers is to ensure that one of our primary goals, which is to ensure the maximization of returns, is to actually, that's what we are actually focusing on, that if that should even be the case, we will do well to maximize returns and ensure that during the year we make a return above 0%. However, this will be based on our expectations of market conditions. And if these market conditions should change whatsoever, same way that we thought is extremely important to meet you today to engage you on this, we will definitely communicate as and when market conditions change or deviate from the expectations that we have. And in addition to that, if it becomes a reality again, what it also means is that on the day of implementation, scheme members will not experience any immediate impact to the value of their funds. However, because the coupons on these bonds are low, what it means is that going forward, the returns, the way the scheme will be growing won't be as aggressive as we are used to seeing it grow in the past. Thank you.
Yeah.
Can
Thank
I
you,
move on
Yvonne.
to?
Yes, please, you can.
Okay. So we believe that it's really not a good enough offer that protects scheme members' funds because it's for retirement, right? And it will be unfair for you to put money down for this event and then before you realize the money that you've grown is going to be cut short. So what we are doing, we totally understand. We are scheme members just like you. We totally understand that this is unfair to us. It's not a good enough offer. And we are actually directly engaging the Ministry of Finance on it. And together with the other trustees, that's the chamber, like Solomon mentioned, and our regulator, we are actually engaging the Ministry of Finance together with them to ensure that if there should be any form of debt restructuring that has to come in, at least scheme member funds will be protected. Thank you.
Okay, thank you, Yvonne. That is encouraging to hear. But I would like to direct this question to you, Rita. On the debt exchange or debt swap, as we've heard of it these past couple of days. And I'm asking this question because there's a question in the Q&A that is seeking to understand the difference between individual investors and institutional investors, because I think in the announcement, the minister did mention that the principles of individual investors was not going to be affected. However, the same does not hold true for institutional investors. I would like for you to throw a little bit more color on the differences between the two, and that pension funds, are they institutional funds? And as an individual that I invest in a pension fund, will I be affected? Am I part of those individual investors the government is talking about whose principles will not be touched? Or the story is not the same for me? If you can just provide some clarity on that for us.
So thank you, Solomon. And so per the proposal or per the offer that's on the table, there's a distinction between individuals and then institutional funds. And so according to the proposal, when they refer to individuals, they're referring to people who are holding these securities that we've talked about in their own names. And so, for instance, if it's a bond, you are registered on the Central Securities Depository and the bonds are in your name. Those are what the ministry refers to as individuals. Now, when it comes to people who are invested in pension funds and in other funds in the market, the securities are not in your individual names. The funds have pulled everybody's funds together and then has purchased those investments on behalf of everyone. And so the securities are allocated to the fund and not individual human beings within the fund. And so per the proposal, if you've invested in a fund, say your pension fund, your mutual fund, it's considered an institutional investor. And per the offer on the table, those are the funds that will be affected. And then individuals who have actually registered and hold the securities on their own Central Securities Depository in their own names are those that are being referred to as individuals, and as such, per the proposal on the table now, are not going to be affected. Yes.
That's interesting. Courage, this is to you. So in relation to this debt swap or exchange, for the market players within the financial space, how is it going to impact these players, and who is going to be affected the most? If you can, I would like you to sort of tear it up. Let's see the player that will be affected the most and the player that will be affected the least by this debt restructuring attempt by the government.
Well, thanks a lot. But if you look at the nature of the holdings, basically it trickles down to somebody's funds. So whether you like it or not, somebody will ultimately be affected, right? So we can say the banks, by their high exposure, by their high purchase or holding of government securities, are very exposed to government of Ghana securities. If you put together Bank of Ghana and the commercial banks, we are looking in excess of 50% of the total outstanding government of Ghana bonds. The commercial banks themselves are looking at almost 1/3 of government of Ghana bonds outstanding. And so the banks looks very exposed to that. But at the end of the day, these are human beings funds. So we can trickle it down in that sort of format. So, but what I would like to emphasize though is, again, I would also associate myself to Yvonne and Rita that it is an offer. And so we still would want to trust our institutional investors through whom we invested as individuals to push the agenda, because they very well understand where we are and they have a voice, either as an institution or as an association within which they belong. So we want to expect that that is what they will do and argue out our case for us as individuals. But also, the point I wanted to also make is that at the end of the day, there are also measures that the regulators have put in place or are putting in place, realizing very well that any unconsidered or any misstep in the process of this arrangement or changes in this arrangement can negatively impact the continuity of some of these institutions. And so they have stated that there will be something they call regulatory forbearance. That's a big word. But what it means simply is that the regulators like Bank of Ghana, Securities and Exchange Commission, National Pensions Regulatory Authority, National Insurance Commission, and so on and so forth, all those guys will have patience to handle institutions that may be negatively impacted by this. They would also stand ready to support in terms of financing or liquidity to this institution in the unlikely event that they suffer any negative shock to this. And in that regard, they've talked about setting up what they call the Financial Stability Fund with the support of development partners, which will contribute to a fund that can also be available for these institutions to tap into as to whether it will be free fund or borrowed funds. And that's something we still need to have an engagement with the government to understand at what cost these funds are coming. But ideally, there are measures that is being put in place to ensure that participants, and even at the individual level through institutions, do not suffer too much pain in the whole process. I think that's what I would like to also bring to our attention.
Okay. So my question to you on that would be, we've talked at length about what the situation is, what government is doing to mitigate the effects of the current economic crisis. But the question that is, I think, is on everybody's mind and on my mind as well, is when will all of this end? Is there an end in sight? When can we start breathing easy when it comes to our pockets? Can you offer some encouragement?
I would try my best to do that, but I think that we need to be sincere. This is a difficult situation. When it all started, we thought, oh, we've seen it all, but we kept seeing different lows, shock after shock after shock after shock until this point. And so I would have to be very humble to say that no one knows for certainty when all of this will be over. But what we know for sure is this too shall pass. Because if you look at the start of this discussion, I said that we are at a level not seen in almost 2 decades. It means that this is not a recurring situation. And so we should expect that the market will turn favorably. And once the market turns and interest rates come down, partly because inflation would have come down, partly because the IMF program would have started, then bond prices on the market will start to recover from their current lows. And when you value your mutual fund using the prevailing market price at the time, then bond prices or your investment returns or valuation can start to go up again. But a lot depends on how quickly government can start the IMF program, because until you start an IMF program, it appears investors on the market are not ready to re-engage with the government of Ghana with new funds or with new monies, so that even if some of the investors decide to leave their existing money in the economy, some of them are not ready to bring new money. So a lot depends on how quickly we can start the IMF program. And starting the IMF program is also dependent on how the government can engage quickly and reach an amicable and equitable solution or resolution to the debt restructuring arrangement or discussion that is ongoing. So it will be difficult to put a specific timeline to all of these, but there is this assurance that this is not a recurring problem we have in this economy. Like I said, it's once in 20 years since we experienced this. And so we hope that once the IMF program or the IMF deal starts, maybe somewhere down the 2023 period, we should start to see investors watching government performance under the program. And maybe to also add that we also might have to be a bit measured in our expectation even when the IMF program starts, because the correction might not begin, the turnaround might not begin from day one when the program starts. You know, the market will, having learned their lessons from what has happened, might still want to give it a couple of months to see how government performs under the program before capital starts to flow back and things start to normalize.
Thank you very much, Courage. So the next question on my mind, and this is to you, Yvonne. What is Petra doing to protect our clients and our customers? Yes, it's not looking good, but is Petra doing anything at all to help safeguard the funds of its clients and customers?
Thank you, Solomon. So it's not only what Petra is doing, but it's also what Petra has done. So somewhere mid-year, when we saw this risk, for the lack of a better word, right? What we did was, yes, we looked at it in two folds. We looked at it in terms of liquidity. That's ensuring that we have sufficient cash to pay up any withdrawals that come our way, and then two, maximizing returns. So on the liquidity front, if you look at what we did, the various interventions that we put in place, you'd notice that as at now, we have 10 times the percentage of cash that we usually hold sitting as cash right now in our schemes. So we can put under any withdrawal request that comes our way. And two, we've also secured some liquidity arrangements so that even if for some reason the 10 times that we have, which we believe will be sufficient, isn't, then we can always tap into those as well. Secondly, when we look at the maximizing of returns as well, what we did from that mid-year till date, we stayed away from investing further in government of Ghana securities and even the state-owned and SOE debt as well. We stayed away from investing in those, and it's still the case as we speak. In addition to that, we decided to enter some positions. This was even last year, because this risk, though it was not as intense as we're seeing it now, somewhere last year we still saw it. So in the latter part of last year and in this year as well, we entered into some dollar-denominated positions. So we have some dollar-denominated assets in the schemes as well to cushion returns, or basically maximize the returns of the portfolios. We also took positions in certain investments that did not have a direct relationship with the performance of government securities. So what you notice is that if right now government securities are more, those investments should not be affected by whichever way that government securities perform. And yes, there are some other interventions that we also took. We took that we believe that we may even be the only trustee that might have, but they are all in preparation for this event if it should happen. Thank you.
All right, thank you, Yvonne. There are a couple of questions in the Q&A. I'd like to take a few of them before we continue. And I'd like to direct this question to you, Rita. Somebody is asking, I think Solomon. Solomon is asking, could you kindly explain the difference between okay, Solomon, you said haircut, but the actual terminology is haircut. So can you kindly explain the difference between haircut and the proposed debt exchange, since they both lead to loss of revenue? Is there a difference between the two, Rita? The debt exchange proposed by government and the haircut, or they are one and the same? Kindly give us some clarity.
Sure. So, thank you, Solomon, for that question. I think Courage explained that earlier, but I'll just reiterate and see if we can give some more clarity to the person asking the question. And so, haircut in itself doesn't really say anything, right? Because there can be haircuts on the principal, there can be haircuts on the interest that's on the securities. And so, what the ministry is proposing is not a haircut on the principal. So, i.e., if the face value of your investment is 100,000, what you are proposing doesn't change the face value; it remains 100,000. However, if the interest rate of that security that you were holding was 20%, that is what they've graduated into 20 0%, 5%, and then 10% starting from 2024 upwards. And so haircut in itself, really you'd have to distinguish what exactly you're asking. If you're asking in relation to haircut to the principal, no, there's not going to be any haircut on the principal or the face value according to the proposal on the table now. However, the interest rates on these securities will all be changed. Yeah.
Oh, okay. So just to see whether I get what you mean. So the terminology haircut and debt exchange are sort of not too different. The haircut is maybe the general umbrella term for these kinds of activities that lead to some sort of loss when you are trying to restructure debt.
Yes, exactly, Solomon.
Okay, so Solomon, I hope your question has been answered. There's another question, and Yvonne, maybe you want to take this one. Somebody is asking, let me get that for you. They're saying that should our company stop, and this from Mark Prince, he's saying, should our company stop paying this tier 2 and 3 and add that back to our salary? So this so-called structure is over. I guess what he means is the current economic situation, this debt restructuring and all that we are saying. Should our company stop paying tier 2 and 3 and put it back in our salary so that we can chop the money ourselves?
All right, thank you for the question, Solomon and Mark. So let's go back to some of the things we've discussed already. When we look at our financial markets, a financial market is basically a place or a market where people who have excess money get to interact with those who don't have excess money or who are looking for money, right? So we look at our financial markets and the way it performs. What you see is that it goes up, it goes down, it goes up, it goes down. So if you decide to take certain decisions when it's down, it may be to your detriment, it may be at your disadvantage. The contributions that you are making are for certain objectives or for certain purposes. For most of us here, it's for retirement. What if you should halt these monthly contributions? What it means is that whatever lump sum that you're going to make at the end of your retirement will be reduced, because basically there was a period where you were not making any contributions. We actually did some analysis a couple of days back on how even funds have performed in the tier 3 scheme, Petra Opportunity Pension Scheme, over time. And what we noticed was that over the last 5 years and over the last 10 years, you notice that for the overall money that each member has, for the 5-year period, just the contributions make up 62% and returns make up 38%. However, over the 10-year period, the contributions actually make 38% and the returns is 62%. You have more than doubled the amount of money that you've put in this particular scheme. So you notice that even if you are making these returns, which are almost double what you have made, you've actually contributed. If there are periods where it goes down and goes up, mind you, this 10 years, there were periods it was going up and going down. If you are reacting each time you see this, what it means is that you are actually stifling or reducing how much you actually stand to make. So this is a temporary blip in the grand scheme of events when it comes to the overall objectives that we have when we are making these contributions. So do not halt. You should even bring in more because this is a period where prices are lower. So if prices are lower, it means that you actually get more from buying at cheaper prices. So let's not halt. Let's continue to contribute and stay the course when it comes to the overall objective that we have in contributing to our pension funds. Thank you very much.
All right, thank you, Yvonne. Another question to you. I think we may have spoken about this, but it's good to emphasize a bit more. The question is from Chris, saying that is Petra considering taking the debt exchange offer from government? How will it affect our pensions?
Petra's stance is that it's not a good offer for pension scheme members. Don't forget, we are just like you. We are equally scheme members. So whatever decisions that are taken affect us as well. It's not a good offer. You shouldn't our funds in pension schemes shouldn't be affected, especially because if you think about it, like what Courage mentioned, all of these things, it still trickles down to us. And when it comes to pension schemes, it's for the long term, it's for our retirement. The last thing we need is for this as safety nets, as safe spots that we know that we are putting money down for our retirements being at risk. So it shouldn't affect. So that's why we are continuously engaging. We started, we are not yet done. We are engaging the Ministry of Finance, both directly and together with the chamber. That's the group of corporate trustees that we have in the system and our regulator to basically demand that we get a better offer and our pension funds should not be affected. I just hope this gives that clarity to anyone who may have had that concern, but we are not too happy with the fact that it doesn't really help the scheme members' funds when it comes to the offer that's been put on the table on the debt exchange program.
So Yvonne, does this stand have any implications on our scheme members? So assuming we reject the offer, does it have any implications for scheme members?
So this morning we saw the investments memorandum, the offer memorandum, sorry, when it comes to this debt exchange program. And there was nothing that said anything otherwise. However, the contracts that we have with the government when it comes to these bonds are binding. So the government would have to definitely honor its part if it should reject this offer. So implications is that things will still continue to be the same. That's our expectation. But if anything changes, whether for the better or for the worse, we will still do well to engage scheme members like we are doing today. So at least we are all in this together because we believe that we are working in this together. It's not really about this person or this company. It's all of us. We are one in this. And we understand the plight of every scheme member on this call. And even those who are not here, we understand the plight. We are in very tough times. Things are really tough. Inflation numbers are high. The value of our stuff are going down. We totally understand our pensions. We would want a better offer for our pensions where pension funds shouldn't be affected. And that is what we are going to stand by when it comes to this debt exchange program.
Thank you, Yvonne, for that. Awini Dramani is asking two questions actually in one. I'll direct the first to Courage, and then the second would be to you, Yvonne. So Awini is asking, will government continue to issue domestic bonds at rates higher than the 0%, 5%, and 10% within the specific periods that were indicated in the debt exchange? So yeah, I hope you get the question. If you do, please just proceed.
Sure, I got the question. Thanks for the question. So if you look at the duration or the outlook for the new bonds, we are looking at cumulatively 15 years. I mean, 2037 is 15 years from now. And over this period, you still expect government to come onto the market and do business because government will still have to spend. The revenue they would take to spend will not be enough. And so they will have to come to do some borrowings and so on and so forth. So we still expect governments to come back to the market to do new borrowings. And these new borrowings, the interest rates, what we believe is that will be determined by the market conditions or the prevailing conditions at the time. So this new offer should not be a determinant for any new borrowings that the government will do in the future. However, it looks unlikely that 2023 will see government active on the market. Of course, the treasury bill side, those are the short-term securities which are not part of this whole exchange program. Those ones are for government short-term financing needs. And so we expect that those ones will be ongoing because they haven't been touched. And so they should continue even in 2023. But when it comes to the longer dated ones, I mean, the bonds and so on, government will definitely come back onto the market at a point, but not very positive about an immediate return as early as 2023, because this is a time where they don't even intend to pay interest on the existing bonds for the whole of 2023. And so if you come to borrow in 2023, are you borrowing at a new money at 0% interest rate? So for 2023, it looks unlikely for us to expect government to come immediately. But beyond that point, government would definitely have to need more money to support its agenda. And so government will definitely come back onto the market, even under the new bond program, or the exit bond, as they call it, the 4 new bonds.
Okay, so what you're saying
But
that
maybe I should
there is
just add that those will be new securities, they will not be commingled with these 4 new securities. Those will be new bonds that will have different type of terms and will be trading on the market under different market conditions.
Thank you, Courage, for that clarity. I think it's very, very important for us to differentiate between the two. The second part of the question, which I'll direct to Yvonne, is this: is Petra under any legal obligation to continue to invest in government bonds?
With the introduction of the constituent funds, we are. So you notice that for some of the constituent funds, we are required to have certain percentages when it comes to government of Ghana securities. So we basically have our hands tied here when it comes to the government bonds and the requirements of us to actually invest in them.
So we would still be investing in government bonds, is what you're saying?
We will, but the thing is, we'll be reducing the exposure over time if our expectations continue to be the same. If things get better, we would look at increasing exposure there, but we'll continue to reduce the exposure together with the contributions that we receive and the other investments that we'll place in our growing the fund to reduce the risk that the schemes would face when it comes to government of Ghana securities.
All right. Thank you, Yvonne. Rita, this is to you. And Dinah is asking, what are the benefits of investing during these times? What are the benefits of investing during it? Should I invest at all?
Oh, sure. And thank you so much for the question. Thank you, Dinah, as well for the question. And you know, there's always an objective for investing. And so if I relate to the topic under discussion today, which is your pension fund, the whole objective is so that when you are no longer working, you would receive some income to help you. Now, I think throughout this conversation, we've talked about, prices and the value of investments going up, going down, and that in these times, the prices of investment securities have come down. I think even Yvonne mentioned that this is actually the time for you to be buying more because things are cheaper. And so maybe in simple terms, imagine you go to the market and then maybe tomatoes are in abundance, and so tomatoes have become cheaper. It rather makes sense for you to go and buy more tomatoes and store for times when tomatoes become more expensive. It's in the same vein here as well. As these investments have become cheaper, there's the time for you to buy more because you get a lot with less money. And then when things, start to improve, the value of your investments, which now you've bought more of, increase aggressively as well. What you would typically see is that people rather react in the opposite direction in times like this. And so when the value of the investments have gone down, that's when they are rather taking out their monies. And so they are crystallizing those losses. Mind you, you only crystallize these losses when you take out your money. But if you keep it when the market turns, the value of your investments goes up again. And so I'll say that this is actually the time where you should be taking advantage of the reduction in the value of these investments and be investing more. Thank you.
Thank you, Rita. There's another question here. The first part of the question has already been taken care of, so I'll ask the second bit, which is saying that per the NPRA's investment directive, as it relates to asset allocation, there is trustees are supposed to allocate about 70% or more into government securities. Looking at the current conditions that we have right now, are there any options available for rebalancing the asset allocation as it pertains to government securities, or it is going to remain the same? And Yvonne, this is for you.
Yeah, thank you very much for the question. So I think I alluded to it earlier, but just a bit of clarity. That's percentage you see in the guidelines is the maximum. So there's still wiggle room to bring that percentage down. So rebalancing is pretty difficult in these times. I'll be very honest with you, because as it even stands, should we decide to exit some of our government securities positions, what it means is that the low prices that are on the markets would be the prices at which we'll be selling these securities at. And that means that we'll be making losses on the sale of these securities, right? So it's a very thin line that we are treading together with our fund managers. And we see an opportunity to exit some positions, we do. And we definitely are hoping that contributions continue to come in, so that at the end of the day, that's forming the denominator on which we are getting the exposure, or the percentage of the government of Ghana securities is to the schemes starts to grow, to enable us to reinvest those funds into better yielding investments that give us better interest rates with a desired risk level, whereby it's not too risky for the schemes, but it's giving us or compensating us sufficiently and adequately in terms of return to overshadow whatever down moments that the government of Ghana portfolio is going to have in the schemes. But to be honest, rebalancing is a tough game to play at this point in time. And we are doing all our possible best together with the fund managers to ensure that we still maximize the returns for the scheme members. And some of which I've actually just highlighted in this submission. Thank you.
Thank you, Yvonne. Rita, there's a question that is directed to you. In your earlier response to the first earlier question, sorry, you did mention it makes sense for us to still put money into our investment because prices are actually low at this point. But we are seeing, as we said, we are seeing a reverse, people panicking and coming in to take their money out of their investments. And one of the reasons why what people give to take their money is that I'm going to put it in I'm going to buy dollar, right? Is breaking an investment that you have to go buy a dollar now a prudent thing to do? What would you advise people who have this kind of mindset?
Sure. So thank you for the question. And so, like I mentioned earlier, when things or when the market is down and you panic and you make emotional decisions, that's when you actually end up even making more losses. And so when people are talking about going to buy dollar, the truth of the matter is that you will not be able to buy dollar from the bank just for the sake of buying dollar to hold. And so what would you have to do? You have to rely on the local, I would say, FX dealer in your neighborhood to get the dollar. Now, how sure are you that the FX that you're even buying is legitimate currency? And so that's risk number one. Risk number two, in times like this, right, everybody turns into an investment advisor. But remember that we have professionals who have experience in managing funds, both in good times and in bad times. And so the most prudent thing that you can do for yourself is to speak to the professional, let them assess your situation in the context of what your objectives are, and they would advise you as to the right decisions to make for your investment. Thank you.
All right. Solomon, if I may add, in response to some of these needs of customers, Petra in the wider foray have been designing products that meet some of these needs of customers. One of this in relation to the opportunity that foreign currency holds is a new fund, the Sentinel Eurobond Dollar Fund, which is not domiciled in the Ghana Eurobond. And so you are allowed to be able to purchase into this fund, which enables you to get the opportunities and the growth opportunities that holding foreign currency actually offers you. This is safer because, I mean, even if you are able to access the dollars, the physical dollars on the market, I believe all of us know now, a lot of people know that quite a number of people have dollars under their beds, and it is leading to a lot of robbery. You don't want to find yourself in such a place. So Petra has been working on a foray of products that meet their needs at this time. People need liquidity. We are working on a pension-backed loan product, which is live now, that you can actually, based on your pension asset, access very affordable loans to meet your liquidity needs today without having to break your investment and lose the value of your investment. One of the interesting things I found as well is that the long-term nature of investment is such that as the years goes by, your returns and your benefits actually multiply. So over a 10-year period, you would find that the total money that you receive contains about 10 to 15% of your contribution, and about 90 to 85% is actually interest that you have made. 10% of 10 CDs is 10%, and 10% of 100,000 is as a thousand of that 100,000. And so it is not a great move to break a long-term investment to satisfy an immediate need. And in line with that, we have the Eurobond Sentinel Fund that Petra is selling, allows people who are interested in foreign dollar denominated investment to take opportunity in a safe way. We have pension-backed loans, which enables people to access liquidity for their domestic needs instead of breaking investment. The third thing is that, as I said before, markets fall and they rise. As Rita said and the panelists have said over here, you don't want to take a wrong decision when markets are falling. In fact, it's going to rise. If markets don't rise, then we all die, to be honest. They fall and they rise. In 2000, the markets fell and rose. 2008, the housing bubble, the market fell and rose. 2015, the market fell and rose. And we have 2022, the markets are falling and they would rise again. These funds are long-term funds, and you wouldn't want to lose out on the long-term nature of these gains by taking some rash decisions. So speak to an advisor at Petra, and we would attempt to meet the needs that you have, and whether you are interested in things like dollar investment, whether you have liquidity needs at this time that you really need funds to support you with, or you are looking at how to restructure your wealth plan to achieve the goals that you have. We have pension-backed mortgages that are live now. We are currently piloting the product that enables you, based on your pension fund, to access the 100% mortgage. I know people are taking their monies and they are trying to buy houses. Unfortunately, they don't have enough to buy houses or lands, and it is leading to a lot of losses. And these are the things that we sort of speak about. And so we have these foray of products that meet the needs of clients at this time, and they are available today. And so speak to somebody at Petra about these products that are available to meet the needs that you have. And our promise is that markets falling, right? That's what we can tell. We don't know when the rise happens. Nobody can really predict, but we believe and know that it will rise. And we are in this together. We will represent your best interest and ensure that we both get the end that we all aim to see out of this. Thank you very much, Solomon.
Thank you very much, Eugene, for that input. So we are fast running out of time. So I'll take a couple more questions. Then we can bring today's webinar to a close. Just a quick reminder, this is just the first in a series of a number of webinars that we intend to hold, just to educate our scheme members and the general public on what's happening within the financial space and what's happening with their funds with us as well. So we'll take a couple of questions more. And this question is directed to you, Yvonne. Kofi is asking, in the last 1 month, we've seen a consistent decline in Tier 3 and Tier 2 pension funds. An earlier speaker mentioned that pension funds are held to government, are held to maturity, but not marked to market. If so, what is accounting for the consistent reduction in the funds?
Thank you very much, Solomon and Sophie, for that question. I think it's a question that I should have addressed earlier during one of my previous submissions. But if you recall, I mentioned that part of the interventions that we took was to actually purchase some dollar-denominated assets for the schemes. That's the Petra Advantage and Opportunity Pension Schemes. And what that meant was that for those dollar-denominated assets, they are going to be valued with whatever exchange rates that's available on the market at each point in time, right? So if the exchange rate goes up, what it means is that for those dollar-denominated assets, we'll be seeing gains. And anytime that the exchange rate falls for those dollar-denominated assets as well too, we'll be seeing declines, right? As it stands for the two schemes, they each have over 20% in dollar-denominated assets. So, like I mentioned, anytime that the exchange rate falls, you see it impact the scheme adversely. In the past few weeks, the cedi has strengthened against the dollar. So basically, we've seen the exchange rates falling, and that is how come we've been seeing the declining trends in the past few weeks. But like we've mentioned, financial markets, they go up, they go down, they go up, they go down. We are just in a down moment. It's going to bounce back. I mean, in the history that we've known, we haven't seen any period where the Ghana cedi has strengthened against the dollar for an extended period of time. So we know this is temporary, it's short-lived, and it's going to start to depreciate again. So that is actually why we saw the dips. It was because of the dollar-denominated assets that the two schemes hold. Thank you.
Thank you, Yvonne. We'll take one last question. So Solomon is asking, how does these conversations we are having affect savings booster, which is post-tax savings? So does it affect savings booster in any way? Is it worth continuing any form of savings at all? I think you probably have addressed it in some way or form, but on the savings booster part, maybe Yvonne, you would want to share some light there as well.
All right, thank you very much to Solomon for that question. For the savings booster, yes, all of these conversations do affect, right? Because we are making these same investment decisions for savings booster. So it also has dollar-denominated assets, over 20% in dollar-denominated assets. So anytime the exchange rate goes up, we'll be seeing gains. Anytime the exchange rate falls, we'll be seeing declines. And it also has government of Ghana securities. Over 50% is being held in government of Ghana securities. So what it also means is that if, because it's an offer, but if this debt exchange program becomes the reality where everyone is forced into it for some reason whatsoever, right? It means that it will also affect that portion of the savings booster. So yes, all of these conversations affect savings booster. But at the end of the day, I'm guessing that the question is in twofold because I'm sure he's wondering why continue investing in savings booster if all of these things are affecting or going to affect the savings booster. And like we've mentioned multiple times on this call, it's in your best interest to keep the money invested. Truth be told, the Ghana cedi is going to continue to lose value. And if you decide to take out your money now and hold on to it, you end up losing value because your money won't be making any form of return. Secondly, savings booster, let us not forget that savings booster is not just simple interest where it's just going to grow at a fixed rate day by day, but it's compound interest. You're going to be making interest on top of interest. So each time that you dip your hands into the savings booster pool or your account in your savings booster account, you are actually hitting your investment goals because now you are reducing the amount of returns that you can actually be making. In these times, too, Eugene actually alluded to it in his submission. We are in tough times. Let's be honest. We are in extremely tough times. I'm feeling it. You're feeling it. Everyone is feeling it. And in such times, we've seen it already start to happen where crime rates are rising. Take your money out. You realize that you keep it under your pillow or something. You are at risk. I'm not saying don't steal from you, but you are at risk. You put it there and someone ends up coming. God forbid that ever happens. But if someone does, you are at risk. You lose all of your savings. the various institutions you want to put it as to, they are all facing the same situation as we are. It's like nowhere cool in layman language, right? So it's in your best interest. Put it somewhere where you have experts managing the funds for you. We are trusted partners when it comes to this. We'll manage the funds for you, continue to make compound interest, where the interest or the returns you are making is not only on the amount of money you put in, but it's also on the interest you've already made on the amounts of money you put in. So that at the end of the day, when we get out of this cycle where we are down and we start to go up, you actually start to see the aggressive returns that you've been making for yourself. So please continue to invest your money in the savings booster. Don't take it out. But like Eugene also mentioned as well, if you have other forms of investment needs, you should kindly contact the Petra team, the financial advisor. They can be able to help you put together a plan that might help you when it comes to the various investment needs that you have. We also have a mobile application called Achieve that has curated different products as well based on different investment objectives that different investors might have. You can always access it to see if it meets some of the needs that you're looking for. But for savings booster, just keep it in there. It's in your best interest. Thank you very much.
Just keep it in there. Thank you, Yvonne, for that. This question just came in, and I like the question, so we'll take this one last question, and this is directed to you, Rita. This is the last one. It says, dear panelists, with the mark-to-market valuation, kindly explain, from my understanding, how much can I obtain a unit? Will it be as the same as what was before the mark-to-market? So I'm guessing the person wants to understand whether there are changes as it relates to the number of units that they can get for their money based on the valuation of the fund, whether mark to market or mark to maturity. So maybe Rita, you can help us with that.
So thank you. So if I understand the question, the person is asking if he was to invest in the fund today using the mark to market valuation, is he going to whatever units he's going to get, is it going to be more or less than if it was being amortized, right?
Exactly.
Sure. So that really depends on the valuation of the fund since inception. So for instance, if the person is investing in a fund that has been marked to market since even before this requirement by the SEC, and I'm using the SEC because that relates to the mutual funds, and those are the funds that have received this directive. And so if the person was investing in a fund that was, marked to market already, then there is no change. Whatever value that your funds can buy at any point in time in any day, that's the same amount that you can buy on that set day, because the funds are already being marked to market, right? So nothing changes in that regard. If the fund was not being valued as such, and so if it was being amortized, and the assumption was that the fund was going to be held to maturity, and then there will be a change. And so because now the valuation has to change to reflect what level you can actually sell the securities in that fund for in the market at that particular point in time. And so again, because of the situation that we are in right now, the assumption is that those securities were bought at a time where the market was good, and now the market is not good. And so the assumption is that most likely the value of those investments have come down. So if you were buying in today, you probably will be buying more units because the value again of those securities has gone down. It's become cheaper, and so you'll be buying more units. That's where fund that was being amortized and now is being marked to market.
All right, thank you so much, Rita. Unfortunately, we have run out of time, and we need to bring our discussions on today's webinar to a close. I'd like to thank all the panelists that joined us today for all their contributions. Rita Yabwa of Black Star, Harry Mate of IC Group, and then, of course, Yvonne Bolega of Petra. Thank you so much for your time today. And also a big thank you to our scheme members who join us today. We hope that all that has been discussed will bring you some clarity on the issues that are affecting us today, and also give you some sense of what you need to do in these times. And I think there have been a lot of direction as to who to speak to or where to get advice from in these times. So let's make use of these avenues, and let's seek the right kind of advice in these times, so that we do not end up hurting ourselves. Again, in extending thanks, I would also like to thank Eugene for joining us today and helping us with some of the questions that came in. The General Manager for Petra Trust, we are grateful for your time, sir. And also to all the organizers of the webinar, thank you for putting this together for our scheme members. As I mentioned earlier, this is not the last in the series. It is just the first. We'll have a couple more coming in a few weeks. So please stay tuned on our social media handles, Petra on social. We'll communicate via those means, and also through the other communication channels that you are used to, emails and the like, and inform you when the next webinar will take place. We hope that you'll take advantage of it and join and learn something and educate yourself, inform someone as well. Again, this webinar that we just had will be available on our YouTube channel, so you can, and also on Facebook, so you can share the link with friends and family and loved ones, and to help them also to be as informed as you are today. So thank you all for your time today. It's been a wonderful time having this discussion with you all, and we hope that it has benefited all of us today. Until next time, we wish you all the best, and may God keep us all in these difficult times and bless the work of our hands, so that we can all come out at the end of this tunnel smiling. Thank you for your time once more, and have a lovely day. It's bye-bye for now.